Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking about one of the biggest markets in the world, and it's not the equity market, it's the bond market. It has been in a bull phase, as best as we can work out, since about 1980. If you were sitting here in 1980, would you have said that bond yields would go down for 35, heading on to 40 years? With me to discuss the bond market and where it's at is David Allingham from Eli Griffiths and Simon Conn from Investors Mutual. David, I'll start with you. Are we in for another 30 years of bond yields going down around the world?
Good question. Looks a little bit hard to call, I think, Matthew. At this level, we've had compressed bond yields move post-Brexit to sort of unforeseen levels, and really to make more money out of bond proxies in the equity market, I think we're going to need to see further yield compression. That clearly is dictated by the Fed, and I think is something that's is going to be a risk for these bond proxies over the next 6 to 9 months particularly. We look at a couple of metrics. The FOMC provides some great survey and estimate data in the dot plot, and if you refer to a chart that you should see in front of your screens now, the dot plot's a great way of tracking what the FOMC members are expecting, where they see the Fed's target rate, funds rate, to be over the next 2 to 3 years. And you can see also there from March 14 how much it's moved as we look into June 16, the most recent data. The futures market is now only pricing one interest rate hike by the Fed in the next 2 years. And I see that as quite a risk.
So no reversal in the market there for a while, it sounds like. Simon, we've got the unusual situation where we thought yields couldn't go any lower, and then someone came up with the idea they could go negative. And that's happened in Europe and Japan, especially at the short end. What does that actually mean if you're an equities investor? Is that worrying, or it's been a good thing of recent times?
Look, they're uncharted waters, aren't they, Matthew? It's a very difficult time to we don't have any historical context around this. But I think, as David was saying, I think the pressure has to be at some stage with inflation moving up in the US. I think we have to have seen the bottom, or getting close to the bottom in terms of bond rates. And so equity markets, I think, to have to start to adjust to, have we seen the bottom of these bond rates, and in terms of pricing that in some sort of movement at some stage. I think that's what has to.
So if it hinges on inflation, which it traditionally has, where does that come from? Because we haven't had it for a long time.
In the US, the labour market's getting quite tight. And we are seeing real wage growth. I think, what the US economy is showing is to spread the wealth around, to get further economic growth, and to deepen the economic growth, you have to start spreading the wealth. And so, Walmart, for instance, last year put up the wages to their staff, and through the broader economy, I think we'd have to see some wage growth. And I think the statistics are showing that inflation's starting to pick up. So I think that's sort of the question mark and probably the indicator for what's going on with interest rates.
Okay, Dave, let's go down that path. Wages tighten up, start to rise in the US, we get some inflation, bond yields jack up, go the other way. Equity investors, how do we handle it? How do we get ready?
Well, I think, unlike the GFC where we saw REITs correct viciously because they were overgeared, I don't think we have that issue this time, but I do think valuations are stretched, particularly in the infrastructure and REITs sectors, and they are vulnerable to only a small move in bond markets. And as I said, only 2 years ago, the market was forecasting 7 rate rises. It's now only forecasting 1, and I think, as Simon points out, there is pressure building. I think there's a chance we might see a rate rise in September from the Fed. In the last 5 days, we've seen the Japanese government bond market correct quite savagely from very low levels, and it just shows that only a small move in bond markets can have quite big ramifications for the pricing of bonds, and I think that does have ramifications for some of these stocks. I don't think we go into a deep corrective phase, but I think over the next 6 months they are a tactical sell.
And what's worse, deflation or inflation?
I think for the time being, deflation is worse, which is clearly what the Fed's been anxious about. But equally, they don't want to get too far behind the curve, and that's why I think, particularly in the latest Fed minutes from June, Janet Yellen's been very clear to say that the global risks are decreasing, and then I think they are looking to raise rates by December and potentially preparing the market for September as well.
Simon, let's go, same question to you. Say that we do get a bit of inflation and it surprises everyone and the Fed is behind the curve. Bad for equity markets?
Yeah, look, I think one of the themes we've seen over the last 7 or 8 years since the GFC is this sort of the man in the boat sort of syndrome, where everyone creams from one side of their boat to the other side. And we see, as David was alluding to, there's a lot of money floating around the system. The very liquid markets, and you see people move from one trade position to another. So that goes from being very long to to the shorters going into stocks. So you do see valuations move. Though I think the underlying trend is something that equity investors shouldn't lose sight of. It is a low growth environment. I don't think that's going to change. So while we might see some movements up in rates, I don't think we're going back to sort of 8% cash rates in a hurry. Fed tends to move rates quite gradually. And I don't, I suppose the question then you're asking is, do they get behind the curve? So in terms of equity markets, I think, you've got to start thinking, position yourself. At some stage, rates have to start moving up in the US, how that plays out, how they deal with the US dollar, which obviously will strengthen on the back of that. But I don't think, rates are going to ratchet up in a rapid rate.
Okay. Put you on the spot, have we seen the absolute peak in the bond market? Is the bull market over?
Well, arithmetically, we can't go much lower in terms of bond yields, can we? I mean, they're getting
so that's
to levels.
A yes?
Yes.
All right, Dave, same to you to finish.
Morgan
off on.
Stanley are calling a 1% bond yield in the US, the long bond. I think for that to happen, we'll need to see the very strong lead indicators of a US recession on the horizon. There is some chance of that. Broadly, people are saying 30 to 40%. I think the chances of that are less likely. So I think broadly we are seeing probably the highs in the US bond market, which will lead all global bond markets to bottom ultimately.
It's been a big party for 35 years, but it might be just coming to an end.